Here is something the folks in crypto get completely wrong. And it's something that the people in traditional finance actually understand pretty well. I've studied the traditional finance theory. I've done a master's in financial analysis and investment management. Not saying this to brag, but simply to point out that I know the differences between those two worlds. The people think very, very differently. The things that traditional finance gets very well is measuring risk versus return and measuring how to reduce that risk, keeping the same return, thus improving the risk to return ratio. The best way, obviously, to reduce risk for free is to diversify, right? To own more than just one asset, to own many different assets. And by doing that, you have the chance that your overall portfolio volatility isn't that erratic, isn't that big. So you want to buy different assets, and when one asset crashes, maybe the other asset still is somewhat in okay shape. So your overall portfolio is relatively smooth. So you want to own assets with a positive expected value long term, so they appreciate long term, but at the same time, those kinds of assets shouldn't do the same things at the same time. So the analog example in, say, the traditional world, in traditional businesses, you want to own the ice cream shop, but you also want to own the umbrella shop. As in, no matter what the weather is doing, you still make your revenue. And you transform this into the traditional markets, into the financial markets, and you say, you don't just want to own technology stocks, right? You might also want to own some consumer goods stocks, or maybe some gold, right? Or some bonds. So you own those different things because they move in different directions at the same time, indicating that if all of those things long-term appreciate, that your overall portfolio volatility goes down, the expected return doesn't go down that much, and so your overall risk to reward improves. So this is something traditional finance does well. They know how to diversify, because those guys, they measure correlations all the time, and they measure things like the Sharpe ratio, so they adjust the volatility of your portfolio relative to the return, right? What does it help you if your return is doubled, if your volatility is also doubled? You can easily recreate this by simply putting a leverage on your portfolio, right? So you want to have a Sharpe ratio, you want to have the relationship between your return and your fluctuations, your volatility improve. Now, the crypto guys don't really understand this concept too well. And I see this by the type of diversification that is being done. The most effective way to spread risk is not within an asset class, it's across asset classes. So if you want to diversify somewhat your risk from all your crypto exposure, you shouldn't buy 30 different altcoins, because they all tend to move in similar directions at the same time anyways, right? You've got days where everything is green and other days where everything is red. So what difference does it really make if you own 5 altcoins or 50? In the end, the fluctuations in your portfolio will be very, very similar. So to really diversify, to take advantage of reducing your volatility, you need to buy other things besides crypto. You need to diversify by maybe owning property as well, by maybe owning gold as well, by maybe owning stocks as well. This has actually 2 positive effects. The first one is overall, right, your wealth doesn't go like a roller coaster, and especially once you have accumulated a bit and the wealth that you have is relatively large compared to your yearly income, you don't want to see those crashes, right? You don't want to see your wealth suddenly go down by, say, 3 years of income, 4 years of income, just because you haven't diversified. So it's good for peace of mind to simply have less diversification, but it also presents opportunities. So that's the second reason why you want to diversify across asset classes. Asset classes aren't that well correlated to one another. So when stocks go up, crypto doesn't have to go up. When property goes down, stocks don't have to go down. Bitcoin could also go up. So you have very little correlation between those asset classes, and thus you can actually take opportunity of those divergences. So let's say you craft your target allocations for different parts of your portfolio, and you say, okay, I want to have, say, 40% of my wealth in property, so that's equity of the property, then another 40% in stocks, and maybe 20% in crypto, right? That would be relatively conservative. I guess most people here have more in crypto, but yeah, you define your target allocations. What do you want to have for metals, for property, for crypto, for stocks in your portfolio? Those four asset classes tend to be very lowly correlated to one another. When you have that target allocation, or you have those bands of target allocation, right? It's probably not a fixed number. Once you've got this, you can manage very nicely buying the dip whenever something crashes. So let's say Bitcoin was suddenly to crash 50%. Can happen, right? We have seen the Corona crash. Bitcoin suddenly crashes 50%. Now your target allocation isn't met anymore in your portfolio. Right now, crypto isn't anymore 20% of your portfolio, but only 10. Right? A bit more than 10 because it balances out, right? But you get what I mean. So your target allocation is suddenly way higher than your actual allocation. So then what you can do if you own those different assets is you can sell some stock, right? You can sell some gold coins. And you can put this into Bitcoin. You can buy the dip, balancing yourself out again, risk adjusting everything nicely. And if you want to go even a bit further there, right, you could even have ranges of target allocation. I can say, if I believe things are dirt cheap, then I want to have a target allocation to crypto not of 20%, but of say 30%. And if I think things have already risen quite a lot and I want to be rather cautious with crypto, then maybe my target allocation is not 20%, but 10%. So you still have some wiggle room in this. You don't have to be super static about those allocations, but you need to have an idea of your allocation and you need to have an idea how to take advantage of those dips. If you don't yet have a lot of wealth and your main source of contributing to investments is your regular income, if that's the main thing, right? If your savings relative to your income aren't yet that large, then it's not that important to do that shuffling. But imagine you've got 5 years of your annual income already in those different asset classes. Now it's very important because now if Bitcoin, let's say 20%, right, in crypto, let's say you've got 1 year of income tied up in crypto. If now Bitcoin drops 50%, now it's 6 months of income that are gone, fair enough. But now you can't buy the dip that quickly just with your regular income. Right? Let's say you have a savings rate of 50%, you could, put in half a month of income to buy that dip. But if you actually properly allocate it to different asset classes, you could buy that dip with way more, right? With 6 months, with 12 months of your income. So you can be much more aggressive in properly taking advantage of different movements in the market. And the nice thing about this is also, about the strategy in general, is that you don't have to predict anything too much. Of course, when you want to adjust your target allocations, you do have to have some kind of prediction, right? When Bitcoin already crashed 60, 70%, and you want to have your allocation, say, to 30% of your overall wealth, then you do predict to a degree that it will recover. But besides that, you don't have to do too much of a prediction. You could just be static and say, I always want to be close to 20% and just rebalance and buy the dip just a little bit, not that much. And you can just be reactive. So you're not buying based on what you believe will happen. You're buying and selling based on what has happened. That's a very different way to think about this, right? Most people think, what is the asset that I want to buy that will 10x from now? But maybe that's not really the main thing. The main thing is I have those kinds of assets and asset classes that I believe will be good 10 years from now, or 20 years from now even. I have those core convictions in those few assets, and then I simply just balance the risk. I simply just balance the exposure accordingly. And I just buy whenever it's cheap and reallocate, and I sell whenever there's currently hype around it because people realize that the asset is actually good. Right? There's always this kind of waves of attention. There's a lot of attention, especially on crypto. Then prices shoot through the roof. And if that's not the case, then of course we can also collapse colossally, right? We can go really, really much down because of the lack of liquidity to a degree for Bitcoin and of course also for altcoins. So think about this, right? Think about risk diversification, not just within crypto, because you're really not diversifying. If you have 20 different altcoins, nobody cares. A lot of altcoins crash all at the same time, and you will not be able to buy the dip once you run out of your income. But if you're diversifying across different asset classes, then you can buy the dip, because then you can sell your stock, for example. Of course, this might reduce your expected return to a degree, because crypto tends to appreciate faster than stocks, but it also lets you sleep better. And probably the longer you play the game, the higher the wealth is relative to your income, the more you want to lean towards that side, right? Towards not just betting and YOLOing, but towards actually balancing a portfolio and taking risk on and off based on what had happened. If you found this useful, feel free to give this a like, and feel free to subscribe as well. Well, I publish videos regularly. There's also a free Telegram down below. There's a link. Feel free to check it out. Cheers.